Welcome. Thank you for joining us today, and thank you all for being here in the room and also to everyone online. It's been such a rich conversation already today, and I'm really excited for this conversation because in the last couple hours, we've heard quite a bit about money and about the need to finance projects, to deploy capital, to really get projects going and on the ground. You know, last year in November at COP27, there was certainly the focus on loss and damage, and we heard Selwyn Hart earlier this morning talking about that and the need to mobilize more financing, particularly for the Global South. 2 weeks ago, here in DC, the IMF and World Bank meetings were held as well, where there was a lot of discussions about the poly crisis and the need to really mobilize financing and really engage the multilateral development institutions, the bilateral and multilateral finance institutions to get capital on the ground. The need is urgent, and we need solutions, and we need concrete examples of what's working and what are those tools that can be learned from, adapted, and potentially replicated elsewhere. And so I'm very excited for this conversation with Andrew and Jake today, and thank you again for joining us. You know, I think this is an incredible example of the Nature Conservancy working with the DFC on a model that seems to be working, that has concrete tools to address climate, debt, and development. And they're not siloed issues. They're really integrated and need to be thought of as such. And so I'd like to start off with you, Andrew, and learn a little bit more about the TNC's Blue Bonds for Ocean Conservation and your strategy, and specifically talking about the case study of Belize. I think it's an incredible example to latch onto. And if you can talk a little bit more about the outline of the strategy and the core components of that deal, what makes it unique?
Sure. So first, let me just say this is the second generation of debt conversions, or what used to be called debt for nature swaps or debt for climate swaps. See, because the first generation came out of the Tropical Forest Conservation Act. Those were small transactions in the $10, $20 million range that had large transaction costs, but did result in funding for tropical forest conservation. But that was mainly with official debt, right? It was U.S. debt being forgiven and transformed into local currency to support conservation activities. What we, in partnership with DFC, did in Belize is a whole other scale. So we helped restructure $550 million worth of outstanding debt. It was their entire commercial debt liability. Bought it back at a 40% discount where it was trading and refinanced that with $350 million worth of new debt issued by the government, financed by Credit Suisse, at a 6% interest rate. You may have heard Selwyn Hart this morning talking about the cost of capital for developing countries to do a renewable energy project like 20%. We managed to get it down. They were basically at default levels. Because of the support from DFC, we were able to structure a transaction to buy back the old debt, issue new debt at 6% interest rates. That reduced their external debt burden by about 12%, reduced their debt to GDP ratio from 112% to about 100%. That still doesn't move them to debt sustainability in the IMF sense, but it improved their balance sheet, lifted their credit rating, and reduced their future cost of capital as well. The savings over 20 years, part of it gets put into marine conservation and coastal resilience. So that's generating now $180 million in investments in coastal resilience and protection in Belize that otherwise wouldn't have been on the table. So it's sort of like a win-win-win, because you're reducing their debt burden, you're issuing new debt at a much lower rate that's improving their balance sheet and their credit rating, and you're generating funding for conservation and climate resilience. In the case of Belize, it's principally going to increase marine protected areas around the Mesoamerican reef. For those of you who have ever been there, it's critical to their tourism industry. Like 40% of their GDP is tied up in the tourism industry, which is dependent on the beaches, which is dependent on the reef. And that coral reef absorbs 97% of incoming wave energy in a storm. It is literally the first round of defense in incoming storms. So it's critical to the coastal resilience and to the economy of the country. The secret sauce in all of this, though, as I said, was getting them from default, where they could not access private capital markets, to a AA2 rating, which allowed them to access capital markets at a decent interest rate. And the magic that made that happen was because of the political risk insurance provided by DFC.
Yeah, it's really incredible as an example to talk about that kind of impact. And would love to dive into the details as well. And for those who are joining online, we do have some content that's being pushed out on the platform as well. So I encourage everyone to look at the case study for this. The details are fascinating and the structure is really important, and it's something to be learned from. And when you're talking about the impacts in Belize and the degree to which their economy is dependent on tourism, I think it really underscores the local impacts of this type of intervention and this type of support. And this is novel. This is the innovative financing that people are interested in learning about and understanding more. And so I'm curious, over to you, Jake, from the DFC's perspective, what was the rationale for getting involved in this kind of model? What is the value proposition for DFC?
Sure. Well, thank you so much, Allison and Andrew. It's wonderful to be here talking about and thinking about this, what is actually a very complex structure that reflects many years, maybe even more than a decade of work by TNC on the ground to build the civil society, the policy, the enabling environment framework to allow this deal to happen. When you think about the policy commitment that the government of Belize made in exchange for being able to participate in this deal, it required acts of parliament to actually set aside another 15% of the Belize Barrier Reef as a marine protected environment. But I want to just zoom out for a second in terms of why we were interested in this. And you heard Ali Zaidi here explaining sort of the theory of the case on the administration's approach to climate. You've been familiar with some of the policies and work coming out of the National Economic Council under Brian Deese's leadership, now Director Brainerd, and manifest in things like the Inflation Reduction Act, the Bipartisan Infrastructure Law, the CHIPS Act, where you see this idea of really, I think, kind of exploding what was a previously held view that climate is a drag on the economy. Climate represents a headwind, into something a bit more around the frame of climate representing a once-in-a-generation opportunity for capital formation, for value creation, for investment. $23 trillion. You hear Secretary Granholm beating the drum on this repetitively. $23 trillion of investment in the economy, in opportunities in clean energy, in the transition. And this transaction that we worked on together is so illustrative of that reversal of the way people have viewed climate and the vision of climate as an opportunity for investment. You look at what DFC could do with its PRI to bring the cost of capital down, the rate of borrowing from something in the probably high teens, maybe 20+%, down to 6%, enabling the private sector, Credit Suisse, to come in, underwrite this new bond issuance, and free up $180 million of investment for coastal resilience, which is perfectly in line with the vision for investment in the development of the fisheries economy, of tourism in a sustainable way, to bring dollars into what for us as the USG, but DFC, when we think about our strategy, you look at where Belize sits, right smack in the middle of northern Central America, alongside Honduras, Guatemala, southern Mexico, El Salvador, where we're experiencing a vast migration northward into the United States, creating national security, foreign policy issues. And so this was totally aligned with DFC's mission to be addressing both strategic priorities of the United States, but also investing in development. And we think that it can be a model for doing that all over the world, for freeing up capital, not just in blue ecosystems, in marine environments, but in terrestrial environments, for biodiversity, for carbon markets. The sky's the limit, really.
I think it's a pretty good case for the good use of public capital, and I think that's a question that comes up often. Is this the best use of public capital, and what are the benefits, direct, indirect, and cascading, that could result from it? What also struck me in reading about the case study is not only how novel it is, but also how it's relatively new in the sense that, from my understanding, DFC, the Inter-American Development Bank, are two of the entities that are engaging in this type of model, but otherwise limited, and more need to come on board. And so what needs to be done to galvanize the other development finance institutions, and what needs to be addressed so that they also understand it is a potential strategy for value creation and these iterative economic, social security benefits that coincide? Andrew?
So the number one thing we need to do is basically replicate the instruments that DFC provides and IDB. So we also did a transaction with Barbados where IDB provided a partial risk guarantee. Recently, during the IMF World Bank meetings, the Vulnerable 20 group said, yeah, this is a mechanism that we want to look at. There's a growing sovereign debt crisis, particularly for the developing world. Something like 60% of all developing countries are at or near debt distress. The V20 has said this is one of several mechanisms that we want to look at to help us manage both climate risk and solvency risk. Similarly, the Economic Commission for Africa has created this group called the Sustainable Debt Coalition, which is basically a group of 30 African finance ministers, also saying this is a solution we want to scale up. So we know there's demand from developing countries, from debtor countries. We've worked with lots of institutional investors who said if you can get these debt issuances to investment grade, AA2 or something similar, there's tons of money that go into it. We've heard that from BlackRock, from Nuveen, from others. So the money's there, the demand is there. The critical element that's missing is the credit enhancement. So DFC has a product, IDB has a product. The rest of the multilateral development banks don't have an effective and efficient mechanism or instrument to do this. So that's sort of the first ask, is to get everybody else in this ecosystem who has the balance sheet space to replicate what DFC and IDB are doing. And then we need ways to incentivize those institutions to do it. It would be great if there was more capital for them to provide guarantees, but even in a world where we're not increasing the capital of those institutions, there's plenty of space for them to be more efficient in the use of guarantee mechanisms. And I think that is a critical mechanism as a very efficient use of public capital, because that's how you crowd in the private investment. As I said, it was $350 million of private investment supporting Belize in this. And there's a risk associated with it, and we managed to reinsure out some of that risk with Munich Re. So there's a way to tap private capital markets on the risk management side as well as the investment side. If you look at the capital stack in the accounting towards the $100 billion, we're almost there, not quite. But right now, it's $4 of private money leveraging $4 of public money leveraging $1 of private money. We need to reverse that and then increase it by an order of magnitude. But I see the ability to provide credit enhancement and guarantees to underwrite sovereign lending as one of the best mechanisms out there to crowd in private finance.
I'd like to pick up on that, and we were actually just talking about this backstage, and the importance of other partnerships and alliances in this. And Jake, you mentioned Munich Re as well. What are some of the innovative ways in which they've stepped in to really make these types of deals possible?
So one of the reasons I love this transaction is the more you spend time with it and you sort of peel back the layers of the onion, the more you discover really innovative mechanisms and terms that were written into the deal. DFC is focused fundamentally on crowding in the private sector into transactions. We want to put ourselves out of business. We want to provide de-risking instruments in emerging markets so that the private sector can come in. In fact, the political risk insurance tool has its roots in the Marshall Plan, in the reconstruction of Europe in the post-war era, to provide comfort and confidence to the private sector to invest and participate in capital markets. Here, Munich Re agreed within the structure of the debt restructuring to what was a super innovative provision of a parametric insurance provision, which we care about as climate policy people because we're looking for ways to more easily provide financing in the wake of climate disasters in an inclusive finance model that doesn't require people to go through bureaucratic and cumbersome claims processes, but simply have a trigger for the payout of insurance. And that's exactly what Munich Re agreed to do in this transaction. If Belize experiences a hurricane event that represents more than 20% of its GDP, and you heard Andrew talk about the value of the Belize Barrier Reef for being a barrier to those hurricanes, that triggers a provision that relieves the government of Belize from its debt obligation under the restructuring, and Munich Re steps in as a private sector reinsurer to that obligation and conducts the payment to DFC and to the other lenders. So that kind of parametric insurance product is something that we're trying to scale, that we're trying to standardize, that we're trying to provide when you're talking about a farmer in Pakistan that's lost his or her entire livelihood, his livestock, his crops, due to the glacial lake outflow burst that we heard Minister Raymond talking about. We don't yet have those products readily available for the mass market at scale, but when you start getting reps in and this type of volume and scalability with people like Munich Re in this type of a transaction, it has benefits for our ability to apply those in other contexts.
Great. Thank you, because I did have a question about the mechanisms that will enable scale. I have so many more questions, but really want this to be an engaging conversation with the audience as well. I know we have a question coming in from the audience.
So Ulrich from Guyana is wondering, he thinks that the procedures in place to access the limited amount of climate finance available do not reflect the need for urgent action on both mitigation and adaptation. What can be done to simplify and expedite the existing MOs for such access?
I was going to say, if you've ever worked with the Green Climate Fund, that's probably not a model of effectiveness and efficiency. Right, so direct access is supposed to help with that. What I think is useful in the case of the Belize transaction, or I would look at two other transactions that Chile and Uruguay have both issued sustainability-linked bonds, where they put out a couple $2 billion worth of bonds into the private market. Now, they have market access. They have good credit ratings. But they are linked to the delivery of their NDCs. And basically, they made a promise, we will achieve our NDCs, and if we do, we're going to pay the investors a little bit less. And if we fail to meet our NDC targets around decarbonization and renewable energy penetration, we're going to pay them a little bit more. So you're linking your debt issuance and your balance sheet to your climate performance, which creates, all of a sudden now, finance ministers have an incentive to make sure climate targets are met. But issuing these sustainability-linked bonds or doing the equivalent through these debt conversions and linking your macroeconomic situation to your climate commitments is a way to immediately access money to provide funding for climate action and invests the finance ministers in making sure we're actually achieving the NDCs and our adaptation targets.
Great, thank you. We're out of time, but I do have to ask one more question quickly before we go, which is what's next? We know that the Macron Summit is coming up in June, and that's a real opportunity to talk about the impact for finance and move the dial. So curious from both of your perspectives, what needs to happen there? What needs to happen next to really catalyze this action on finance to enable deployment for projects of this type?
Well, the question that we just received from the audience is reflective of a much broader challenge that we face, which is that the gap in climate finance for emerging markets, and we heard Selwyn talking about, you've got 75+% of emissions coming from emerging markets between now and the future. You've got increasing impacts that emerging markets are unable to deal with, and yet we are at least 1 or 2 or 3 orders of magnitude off in terms of the amount of financing. We're talking about billions, and we need to be at the $1 trillion scale. So from DFC's perspective, our view is that we cannot hit that scale until we crowd in the private sector, until we bring capital markets and private companies who have that kind of a balance sheet, who have that quantum of financing into play. And that's why we're so focused on scaling our work to de-risk those investments. DFC is able, by its authority under the BUILD Act, which was a statute of just a few years ago, to invest up to $60 billion across the board. We are running hard at that number. We hope that we can exceed that number and ask Congress to increase our authority. But something that Andrew mentioned is really important in that, which is that if we're only mobilizing 25 cents from the private sector on every dollar that we put in, that's the opposite of what we need to be doing. So we're also focused on how do we use that public finance to mobilize a 10x multiplier of private finance. How do we turn that $60 billion into $600 billion? And of course, we're working on health, digital inclusion, gender equity. So climate is not the only issue that DFC is tackling, but it's an enormous priority. It's why we're hiring, we're building our team. I would make a shameless plug for those of you in the audience or watching online that if you are interested in this work, if you have a finance background, we need you. We need your energy. We need your enthusiasm. Ultimately, we have to build this team and scale it, and that's how we're going to reach scale.
Great. Very well put. And Andrew, last word, what would move the dial?
More credit enhancement. I'll just take a word from an analysis that the IMF did of these types of transactions and basically said, this is a second best option. The first best option would be a lot more grant financing for developing countries. Totally agree. In a world where that's limited, this is a great next step. And the key to scaling it is more credit enhancement. So I would hope that by the time we get to the Macron summit, there can be a mandate to the rest of the multilateral development banks and other international financial institutions to effectively and efficiently scale and replicate the mechanism that DFC and the IDB already have. If we could get everyone in the system just doing that, that would be the big step forward, more credit enhancement, much greater ability to crowd in private finance.
Great. Thank you both. Best wishes with your work, and thank you again for being here.
Thank you.
Thank you.